Hi, I'm Dr. Tucker Balch with Lucena Research, and in this video I'm going to tell you about portfolio optimization. Now this video is about the science of portfolio optimization. There's another video that tells you how to use the portfolio optimizer that's part of Lucena's Quant desk. Now portfolio optimization is a really important tool, a cornerstone of quantitative analysis. What is it? Well, what it does is, given a set of equities that you want to invest in and a target return that you want to achieve, a portfolio optimizer will figure out the best allocation of cash to equities to give you the lowest risk for that portfolio. Now, before I get too deep into this, we need to go through a couple of disclaimers. Lucena Research is not a registered investment advisor. I'm not either. You should definitely speak with a licensed financial advisor. Do not assume that the techniques we're going to show you here will be profitable. And the stuff I'm going to show you is hypothetical. It's based on historical data, and there's no guarantee that this kind of stuff will work in the future on real trading. Okay, back to Portfolio Optimizer. Portfolio optimizers are part of all serious investment techniques. They're used by the largest hedge funds and investment banks. And again, what it does is it helps you figure out among a set of equities how much you should allocate to each one, so that you can, for a given return, have the lowest risk. Now, what do we mean by risk? Let's answer that by taking a look at two hypothetical stocks. This stock, XYZ, had a pretty good historical performance. It went up 10%. Note, though, that it's kind of volatile. It goes up and down a lot. Let's compare that now to this other stock, ABC, that also gained 10% over the same time period, but it wasn't quite as volatile. It's this volatility that is a measure of risk, and that's what's traditionally used in the finance industry to measure risk. Now, there's other measures of risk that are also valid. This one is convenient in the sense that it's easy to measure. Volatility, how much the stock goes up and down, is standard deviation of returns, and it's a calculation that's easy to do on a computer. Now, we can consider equities, stocks, ETFs, whatever, in two dimensions. One dimension is this risk that we were talking about, or volatility, and the other is return. Now, ideally, of course, what we want is low risk, high return stocks. But as is usually the case, you don't see return without risk. So the highest return stocks also tend to have the highest volatility or risk. But you can view each of the equities that you might want to invest in this sort of two-dimensional view. And when you build a portfolio by allocating a weighted amount of cash to each one of these equities, you get a portfolio that's sort of a weighted combination of each of these equities. Now, the portfolio itself is somewhere on this graph. It has a certain amount of risk and a certain amount of return or expected return. And you would think that it would be sort of somewhere in the middle of all these, of where all these equities are. Well, it turns out that portfolio optimization allows us to do better than that. We can find portfolios that, for a given target return, actually have lower risk than any of the individual equities. And I'm going to show you how in this video. how can we do it better? Well, in the 60s and 70s, uh, a theory of finance evolved called modern portfolio theory. This guy, Harry Markowitz, was one of the leaders, and he discovered a way to combine equities into portfolios that actually have lower risk than any of the individual equities. And he got the Nobel Prize for that in 1990. We used that same algorithm as part of our Quant desk tool, and I'm going to give you an example of that in a little bit. But let me introduce you now to the science behind what Markowitz developed. It's a little bit of math, but it's not too bad. I think if you have an interest in this, you'll find it interesting. Okay, so what goes into a portfolio optimizer? The inputs, like we had talked about, are for each equity a measure of return. What do we expect to see as a return for each equity? Also a measure of risk for each equity, and we have you see there each of our green dots there represents an equity on this map. A target return, so you can ask the optimizer, look, I want to get this target return, and find for me the lowest risk portfolio. So that's the thing you got to give it. There's this other piece of data that it takes called a covariance matrix, and that's probably the most complicated of all this, and I'll get into that in a moment. You feed these inputs to the optimizer. It does a lot of number crunching. It's a really serious algorithm, and it finds the weights for each equity to give you this portfolio. And as you can see here, it's lower risk than any of the other constituent equities, and that's kind of the magic of portfolio optimization. Okay, what is covariance and why does it matter? Let's take a look at that in the context of three example stocks. ABC is the blue stock, DEF is the green one, GHI is the orange one. Sorry, I wasn't creative in naming there. Now notice how the blue stock and the green stock tend to move together. They move closely together. Whereas this other stock, GHI, it shows the same return, but it moves sort of opposite those other two stocks. Another thing to notice is each of these equities has about the same volatility, and they have about the same return. And the magic of portfolio optimization is a way that you can combine them to get a much lower volatility portfolio for the same return. Okay, now there's an important concept here about the relationship between two stocks and how they move from day to day, and it's called covariance. There's another measure that's very closely related. I'm not going to go into the mathematical distinction, but correlation we also use, and the correlation between stock A, B, C, and DEF in this case is 0.9. A high number, in fact, the highest correlation you can have is 1.0, and the lowest you can have is -1. Okay, so a high positive number means they move together very similarly. A negative number means they move oppositely. One almost predicts which way the other one is going to go. So in the same way that the relationship between the first two stocks is a positive number close to 1, the relationship between the blue and the orange stock is a negative number because they move opposite one another. Okay, let's look at a couple hypothetical portfolios built using these equities. Let's suppose we build a portfolio that's half ABC and half DEF. Now, because these stocks move similarly, we expect the resulting portfolio to move like they do. And as you can see, this red line represents the portfolio of combining those two stocks. So it's got about the same amount of volatility, the same return as those two equities. So we don't gain too much by combining those two equities into a portfolio. Now, how about another portfolio? What about a portfolio where we put 25% in the blue, 25% in the green, and 50% in the other one, GHI? So what that means now is we've got about half in the two equities that move together, and the other half in the equity that moves opposite them. Now, because we've diversified now in a stock that's anti-correlated, that's the fancy term for that they move opposite one another, we're going to get a much smoother performance. And as you can see here, of course I just drew this, but as you can see, when you combine these stocks that are anti-correlated, you get a much smoother performance. And these relationships are the relationships that are discovered automatically by by an optimization tool like the one that we use that's part of Quant Desk at Lucena. Okay, so let's go back to this map we've got of risk and return, and each equity is a little green dot there that represents its particular risk and its particular return. And as you recall there, that orange dot was a portfolio we were able to discover. Well, it turns out that for each target return, there is a unique portfolio that is the minimum risk portfolio for that amount of return, and it defines a curve, a line here. So this line represents essentially an infinite number of different portfolios, and each one is a different target return. That one portfolio we discovered is just one of them, but there's a continuum along that line. Now there's three very important portfolios along that line that we provide access to in Quant Desk. One is the maximum return portfolio. That's the one that gives you the highest return, and unfortunately, it's usually it's often also the highest risk portfolio, and that's in the upper right corner of this chart. You can also ask for the lowest risk portfolio, and that's in the lower left there, and that's essentially the portfolio that has the lowest volatility, and you end up with a particular return that is usually lower for that. There's this other interesting point along that line, which is we call balanced, which is in between the two, and that's the one that maximizes the ratio of reward or return to volatility. That one maximizes the Sharpe ratio. Okay, so let's look at a couple examples with Quant Desk. Again, there's another video that goes into much deeper specific examples on how to work with our portfolio optimizer. Let me just show you a couple simple ones that I've put together. Okay, we have this portfolio. It's got four equities. There's AGG, a bond fund, GLD, GLD, which is of course an ETF that represents gold. SPY is an ETF that represents the S&P 500, and USO, which is oil. Now I've built an example portfolio that's just a quarter of the portfolio is in each equity, and you can see its year-to-date performance here along the bottom. We've got a few data points over here. The volatility is 0.73%. That means that on average it changes 0.75% per day. Its Sharpe ratio is 0.15, which is not all that great. Okay, so let's go to the Optimize tab, and we'll take a look at how we can optimize this portfolio. Remember now, there's four equities, and to start with, right now, what we're comparing it to is a portfolio that's got one quarter of the holdings in each of those four equities. Okay, we'll look back over 6 months to do our optimization, and let's start with maximum return optimization. So what we should discover here is that it'll select the single equity that has the highest return over that period. Okay, so turns out that over this period, GLD gold has had the highest return, and it essentially puts 100% of the holdings into GLD. And you can see this chart along the bottom. The blue line is what we started with, our original portfolio, and the orange line is what we would have made if we had put all our eggs into gold. And as you can see, going forward, there's a forecast volatility and a forecast return. And as you can see, the volatility going forward is forecast to be more volatile than what we had been in already. Okay, we'll save that. So our new portfolio now that we're working with essentially has everything in GLD. All right, let's try another optimization. Let's instead go for minimum risk. And before I have it start doing that, take a look at the volatility of this portfolio that we're in right now. It's a fairly volatile portfolio, and going forward, the forecast cone there, diverges significantly because of the forecast volatility. All right, now we'll try and optimize for minimum risk across these 4 equities. Okay, now we've got that back. Take a look at that. Very smooth return. If you compare the 2 returns, we don't get nearly as much as high a return with the original portfolio, where we put all the eggs into GLD. But going forward, we have a much lower volatility. Okay, now let's try balanced optimization, where we're asking it to find a balance between maximum return and maximum volatility. I'm sorry, minimum volatility, of course. Okay, so this is the balanced portfolio, and look, it is indeed much less volatile than our original portfolio. Not quite as high return looking back, but looking forward, also much lower volatility stepping forward. Again, so that's the science behind portfolio optimization. Check out our other videos, in particular the video about details, all the cool things you can do with portfolio optimization with our tool. Look forward to seeing you again, and thanks for checking out Lucena Research and Quant. See you again soon. Bye bye.